Afternoon, everybody. Hope everyone's having a great web summit. And here we're going to talk about investment. And just to start off, I wanted to share kind of the statistic that predicated this topic. And excuse me if I read it out. Since 2002, European VCs have bagged a net annual return of 12%, 12.65%, piping US investors of 12.25%. I'd ask both of you to maybe introduce yourself and your company and maybe respond to that statistic.
Yeah, so good afternoon, everybody. I'm Kevin Holmes, founder and CEO of Founders Network and GP at Founders Network Fund, which is a pre-seed seed fund backing the best members of Founders Network. I've spent my 20-year career working with early-stage startup founders based in San Francisco and Silicon Valley. And a little bit about Founders Network. We do peer mentorship for tech startup founders. So it's 12 years old, 650 members globally, spread across 25 chapters, London being our closest chapter here. And we've had 2,000 companies come through, 5 unicorns, 2 IPOs. So we decided to start a fund to take advantage of that missed opportunity. And that's what FN Fund is. So on FN Fund, all of our LPs are founders who've had large exits, 100 million, 500 million size exits. And we're backing, we've made 6 investments. We've done our first close, doing our next close this Friday. And really, you know, great companies, great founders, multiple exits, great co-investors, great traction, that sort of thing. So very exciting to be doing the fund to back the Founders Network members. A lot of experience working with international founders, especially European founders, coming to Silicon Valley and San Francisco to start companies. In fact, of our 5 unicorns, 1 was from France, 1 was from Czech, and 1 from Mexico City. So you can see the sort of stats speak for themselves. In terms of venture, I think there's a government trade organization that produced this report using Cambridge data. And the thing to point out is that, you know, in the sample size, there's 199 VCs in Europe. There's 2,300 in the US. So in order to understand those stats, which first of all, in and of themselves, are great for Europe. I think there's great European fund managers that deserve to be backed by European capital, not just government capital, but individuals, you know, endowments, insurance pools, that sort of thing. But it's just very much a skewed sort of study in the sense that in venture, returns accrue to the top quartile of funds. So a comparison of the entire asset class by region is a little bit inaccurate, I guess, in terms of a picture of the truth. And also it's the rate of return versus the DPI. So a lot of that is paper markup from the ZIRP era, low interest rates. So a lot of capital out there. Backing, you know, lots of unicorns, and a lot of those valuations are collapsing. So when you actually get to distributions paid back to the LPs, it might look like a much different story. So those are just a few comments on the report. Yeah.
Well, Stephan Morais, I'm managing partner of Indico Capital Partners. We're a fund based out of Lisbon, investing in pre-seed to Series B, mostly Portuguese and Spanish related startups. And when I say Spanish and Portuguese related, means all the Portuguese and Spanish here, all the Portuguese and Spanish everywhere else, and all the foreigners here. So there's a lot of people. It's a very broad definition of global Iberia. Over the last decade, including previously to Indico, you know, we were part of 6 unicorns. Our companies raised more than $2.8 billion. And in the current fund, we have 3 unicorns. At least they're still unicorns, I believe. And I think that to your point about the difference between Europe and the US, the first thing is Europe has really good engineering and really good science. We should not doubt that. There's more than enough capacity in terms of intelligence in Europe, in terms of really groundbreaking companies. But we really have way less capital. We also don't have an exit market because 2/3 of the exit or the software market are in the US and the IPOs happen in the US and so on. So, of course, what happens is suddenly, particularly in the last decade, you have lots of European companies that can become global category winners. lots of European funds like ours and many others that back these companies. So the returns, at least on paper, as you say, they kind of stack up and are equivalent to the US. I think that's a win in itself, because 10 years ago this would not have happened, right?
Yeah.
So I think it shows that Europe came a long way. It's also not only about London or Berlin. It's about Paris, Madrid, Barcelona, Rome, and obviously the Nordics and the Central European countries and Lisbon. And so I think we should all be very happy that we're actually almost being compared to the US, or that on paper it looks like we're slightly better on some sort of metric. But I think we need to sort of solve the capital issue in Europe. We have the smart people, we have the entrepreneurs, the willingness to go big, but we don't have the money. And that's like a huge difference. I remember when we were fundraising in the US for our first Indico fund, and in the US, LPs would say, you know, if you have less than 1 billion under management, you're an emerging manager. It's like, 1 billion? I mean, it's like, we're just so far from it, right? So the average size of the fund in the US is probably 3 to 4 times the average size in Europe, and there's way more funds in the US. So obviously you're also chasing a number of deals with more capital, so valuations are also higher in the US and so on. So, but I think, you know, it's a good statistic, and it means we're on the right path.
Yeah, I think there's like 11x the number of funds in the US,
11x,
and 6x the AUM.
Yeah, so obviously, you know, if that money is going to be concentrated on the good opportunities, that's why your valuations are also in general much higher, but you also have the market then to sort of exit them and bring out the DPI.
And given that we're in something of an economic downturn, what impact does this have on the relationship between LPs and GPs? For example, is there a shift in the balance of power? And what advice would you give to first-time funds trying to raise at the moment?
I mean, I can start with that. I think what you see, because there's not a lot of capital, you know, the sources of capital in Europe are way slimmer. We don't have the university endowments. A lot of countries don't have or have very few private pension funds. The family offices are smaller and way more conservative, sort of geared towards capital conservation rather than capital, you know, growth and appreciation. And so what happens is that the asset class is less well known. So the power between LPs, which are the limited partners that invest in funds, and GPs is not as even as in the US, where you have a lot of great funds and you have a lot of capital, so it's a more even relationship. So the terms, when we compare what is called an LPA, a limited partners agreement, which is the contract that regulates our relationship with the investors in the fund, the terms in the US are more friendly towards general partners, towards the managers. The terms in Europe are generally much worse for us. And so, you know, we usually say that we're kind of like in the middle of very demanding founders and very demanding investors in the funds. And we're trying to make things work kind of in the middle. I think in the US it's a little bit more nuanced.
Yeah, in my experience fundraising, there's been really no negotiation, no sense that the tables have turned in some way with LPs. Again, our LPs are private individuals, founders who've had large exits, some Fortune 500 tech executives, some sort of service firms in the ecosystem who've made money in tech. But pretty much it's a straightforward negotiation or agreement. They want access to great deals. We have, one of them said, you've effectively built like a YC 500 or Techstars in 12 years, and now you're adding the fund, right? So I think as long as you have a differentiated fund that you're sharing to the market, I think, you're going to attract capital. There have been stories I've heard of people raising larger funds from institutionals, and there's a little bit more pressure there. But with high net worth individuals, I think there's, sort of less friction in terms of negotiation. Yeah.
And given this is an investment stage and we're talking about capital, is there any comments you would make to any LPs in the audience listening?
Well, I mean, if you look back at the history of European venture capital, which is much younger than the US venture capital, as we've said, we had the dot-com boom and then we had the bust. sort of 20 years ago, 22 years ago. And that after that followed what was called the nuclear winter of venture capital in Europe, right? Where nobody touched the asset class for a good 5 or 6 years. And then we had the global financial crisis, and then the current sort of ecosystem started 10 or 12 years ago, where with the advent of, cloud and obviously the apps and then everything else that followed, and now AI. But for a lot of the LPs, they still have those scars from 15 or 20 years ago. And I think what is probably needed is a bit of a cultural sort of evolution, so that people try it out and start having some knowledge inside, both family offices and institutions, because we also hear a lot about, well, we've never done venture capital, so we're not going to do it. But if they don't invest in us, we're not going to invest in the startups. There's just no way, if there's no money coming from institutions and families, there's no way we can then deploy this capital into companies here at the Web Summit. So I think we have shown that the numbers are there. We've shown that the startups are good. We have shown that we can actually ship them to the US if needed and do the exits there, so get the money back. So I think we really need, maybe from a state and policy perspective, some sort of policy incentive for these asset managers to actually try out our asset class, because you cannot have only, as you were saying at the beginning, we cannot survive based only on public capital, which is really a major force in the European ecosystem, and thank God it exists, otherwise there would have been very little. But it's just not enough. We need to have private capital to support the next stage of growth of European startups that will conquer the world. Otherwise, we're going to fall behind.
Yeah, I would just add, so some of our LPs are backing both European funds and backing our fund for access to Silicon Valley. So this is one, if you're an LP or prospective LP, that might be something to think about, the diversification. I think, this, to understand this asset class, it's a risk capital. So this is, 10%, 20% of your portfolio, allocating it to risk, which means you have to be okay with it going away. It's nice, as the report shows, that we have returns that substantiate Fund 1, Fund 2, Fund 3, like it's going to outperform, and that's really important. And by the way, if a managing partner has had 5 or is it 6 unicorns? I mean, that's a world-class fund, right? So there are great funds here to back. But I think, in my view, like what gets me excited about startups and what gets me excited about venture capital, and as a potential LP or as an investor, it's not so much the sort of annual rate of return, but it's the extraordinary outcomes that can happen. So a quick anecdote, when I started Founders Network 12 years ago in San Francisco, we were in one of the first co-working spaces. And there was a company in there with us who raised a $500,000 seed round that VC firm later liquidated their position for 2,000x multiple on their investment. The company was Uber, and like that's what we're all looking for, right? That's what gets us all excited. So I think that's important to keep in mind. You can kind of get a little bit too narrow on the analysis. Big picture is this is an asset class for extraordinary returns, and that's what gets me excited about it. Yeah.
And we're seeing a lot of startups raising, admirably high funds early in their investment journey. With that, I mean, does the status of unicorn really still factor into investment decisions?
I mean, it's not really about being a unicorn. It's about having these exceptional returns. So a multiple on your cash, getting in at a reasonable valuation, getting out at a much, much higher valuation. And the math is simple. We are minority investments in our companies, so we have small shares in these companies. If we don't have a huge multiple on our money, and taking into account that many of the companies in the portfolio will fail by nature of being a new business, in the ones that make it, they need to make it big. That's why we call them, okay, they need to be unicorns or hundreds of millions of dollars worth of exits, so that then our little percentage is a big enough number to cover for all the losses of all the other ones. So it's an asset class that really needs to be very picky. I mean, we saw 4,000 deals in the last 4.5 years. We invested in 40 companies, only 40. But out of those, in the current portfolio, 3 are unicorns. And those and a few others hopefully will make up for all the other ones that will not make it, although we hope all of them make it, and that would be great. But reality is this is not going to happen. So we need big numbers. We need companies and founders to aim for the stars and to really be bold and big and ambitious and do things very professionally and work very, very hard, because you don't make a big company by being lazy or copying someone else. But that's why we focus on unicorns. It doesn't have to be a unicorn, but it has to be a really big exit on the stock exchange or some sort of acquisition to make it worth it.
Any thoughts?
I have nothing to add to that.
Okay, I mean, given that we've probably got startups sitting here as well, and people trying to fundraise, whether they're early funding or they're, scaling up, any words? We've got about a minute. Any words of advice for those companies here today?
Yeah, I would just say from the founder's perspective, one of the things I hear time and again from our founders at Founders Network, in the portfolio as well, is that it can take a lot more time to raise here in Europe. It's a lot faster in the U.S. Quick anecdote, Italian founder living in New York. We were the first check-in, took 2 weeks. Another VC fund from Europe took 3 months. By the time they were ready to invest, valuation had doubled. So from an investor standpoint, sometimes it hurts to be so slow. And from a founder standpoint, where would you rather raise from?
Great.
It's a good point. I mean, I think that more than that, and although I think the European funds obviously have a place in the ecosystem, at least to prepare the companies to then go to the US, the truth is we tell our founders to go to the US as soon as possible. If not for fundraising, at least for market. Because the truth is, 2/3 of the software market are in the US. And if you're going to be competitive globally, you have to swim with the sharks. So that's where you have to go. And so one of the first questions we ask is, what's your strategy for the US? And if people say, well, I'm going to stay here and then go to the country next door, it's probably not interesting, right? If someone says, get me a plane ticket and I'll go tomorrow, maybe that's more interesting for us to invest.
And not every company needs venture capital, right?
And
like you can build a great business that is a national or regional business. Doesn't have to be venture backed, and that's great. So I think that's an important message for founders as well.
In fact, the majority of companies are not venture capital appropriate, and they are great businesses, and that's how. But you have to make money from day one, right? You have to sell and make a profit, right? If you're going to lose money, you better have a good plan and some access to people like us.
Alrighty, Stephan, Kevin, thank you so much for being with me today. Thanks, everybody.